Hey guys, hope everybody's doing well today. I'm back with another ETF. This has been a very popular series, and I've been having a lot of comments, and I appreciate those comments about how there's different ways to invest in the stock market. People say I'm bagging on SPHD, and that's not the case per se. I mean, I guess you can take it that way in certain aspects, but I like to say to people there is no real wrong way to invest, but there is a right way for you, right? So, in other words, there's more than one way to skin a cat. And what I'm seeing is a lot of people want income. They're really focused on dividend income. And what I found today, I think, is the ultimate monthly paying, low beta income ETF. Now, if you're new to the channel, welcome. My name's Jerry. I share with you everything that I'm doing as far as research, and I do some portfolio updates. I started investing in 2018 with a goal to retire in 2030 and hopefully sooner. And I'm going to do it on a very small portfolio. And this ETF that I'm talking about today kind of is going to be part of my strategy. And I will be revealing that strategy next week, where I'm going to hopefully I'm going to paper trade and follow a portfolio for quite a few months and see if I can make $200,000 pretty much last forever and draw a significant amount of income off of it. So if you'd like to see that and see my portfolio updates along with my new strategy that I'm going to be following, please subscribe, leave me a comment down below and a like. I'd appreciate it. Thank you. But the ETF we're talking about today is one that is kind of small. Not very many people know about it. It only has assets of $934 million, just under $1 billion. It has good, decent volume that it trades at. When you see volume, I know I'm saying volume wrong. I never can say it right. You don't want to see it thinly traded, and this is kind of low, really. It has an expense ratio of 0.60, so it's kind of high, but when we get into what it does, you'll see why. So what this is an ETF that uses an option strategy. It's non-leveraged, so it does not use money or borrowed money to enhance the dividend it pays. And it follows the NASDAQ 100 buy right index. Now, if we go down and look, and we'll look at the top 10 holdings, or the portfolio composition is what it is right there. And we'll get a little bit more detail on it. The investment seeks to provide investment results that closely correspond before fees and expenses, generally to the price and yield performance of the CBOE NASDAQ 100 buy right V2 index. So what it does is it invests at least 80% of its total assets in the securities of the underlying index. And then what it does, it holds those stocks and sells 1 month at the money NASDAQ 100 index covered call options. So what does that mean? That means that it sells options on the stocks that it holds. So you see it has Microsoft, Apple, Amazon, Facebook, Google, Intel, Netflix, Nvidia, and that's a big portion of its top 10 holdings of its portfolio. It's almost 60% of its portfolio is in the top 10. So what they do is they sell an option that's at the money, they collect the premium, and then they distribute that as a dividend. So it's essentially the ultimate income ETF. It's not relying on the performance of it is relying on the performance, but it's more so because it's writing the options at the money. It's really only collecting the premium of the covered call. And if you don't know what covered calls means, stay tuned to next week, 'cause that's a hint to what my next video will be about. But these guys have done a great job, I believe, in what they do and selling covered calls at the money and collecting premiums and giving out a high yielding dividend. And if we look at their current dividend, they're selling for $20.36 a share. They pay out monthly, and they have a current yield of 11.63%. Now, you can't beat that with a stick as far as how safe this fund really is. If you look up the beta, if you don't know what beta is, the S&P 500 has a beta of 1.0, so that's the standard. So anything below that means that it's less volatile than the standard. So if you see a stock and you look up their beta and it's 2.0, that means if the S&P 500 moves a certain percent up or a certain percent down, typically that stock, if it has a 2 as a beta, will move twice as much. Well, this QYLD ETF has a beta of 0.6. So what that means is it moves 40% less than the S&P 500 or the standard. Now, of course, it did drop like everything did. It went from $24 down to $18. That was a super duper time to buy this ETF. But if we look at the dividends, we'll look, it has 11.63% dividend yield. That's just crazy. So it's paying, look at the dividend history. This is a fairly new fund, but it's been pretty consistent. Pretty consistent in that 18 to 20, 21 cent per month range of dividends paid out to you every single month. And every month they go in and sell those covered calls at the money, collect the premium, and this is the result. So, me personally, I'm not going to buy this ETF. I might at a later date, but me personally, I'm going to take the covered call option and do it myself. But if you want a passive investment that will give you a safe yield for what they do, and being almost 12% right now, I think QYLD is the way to go if you are looking for an income fund, because this is not going to, this fund is not designed for capital appreciation. It's designed for income only. And right now, it's still at a good buy right now with an inflated dividend yield. Now let's just compare it to, like I like to do an ETF channel. I got QYLD up here already, and we're going to compare it with $10,000 invested in QYLD and compare it against SPHD. And we'll click there, and we'll see SPHD has outperformed it in a total return. But if you look at dividends reinvested per share, QYLD, over that time period, 1331 per share in dividends, where SPHDs is $8.90. But the big thing I want you to look at, if you can see in this chart, you look at SPHD. SPHD is the blue line here, and it got almost that $10,000 grew to almost $20,000. But then when we had the market correction here in March, it went from almost $20,000 down to $14,852. So what is that? That is a 30% drop from peak to bottom. And when I'm talking about low beta, this is it in action. This is actually low volatility in action, and that's what the QYLD does. So if you look at it, that $10,000 grew to $16,000, and it dropped to $14,000. So what is that? That's roughly a 20%. Is that 20%? 16. I'm doing top of the head math, so that's less than 20%. So that's the low beta I'm talking about with QYLD. I think they are a better buy at this point in time than SPHD by far, because of the quality holdings that it has and the strategy of income only. So that is all I have. I hope you guys enjoyed this. If you have any questions, let me know. If you are looking for a income fund only, QYLD probably fits the bill quite nicely. I am not a financial advisor. I don't own this, and you probably shouldn't buy it because I'm saying it, because it'll probably tank and go bankrupt just because I suggested it. I'm just kidding. But I'm not a financial advisor. I'm just some dude on YouTube trying to learn this stock market and retire early. So if you enjoyed, please give me a like, comment, and share. I'd appreciate it. Thanks. Bye-bye.